The ghost of a missed opportunity haunts every trader who has ever watched a fortune on paper evaporate into the thin air of market reality. It is a universal pain, the agonizing question that echoes in the silent aftermath of a catastrophic loss. Why didn't I sell? For every 1,000 men who can expertly predict a market's rise, perhaps only one possesses the cold, calculated wisdom to know the precise moment to exit. Jesse Livermore was that one man. His ability to liquidate his positions at the pinnacle of a move, just as the final wave of public euphoria crested, was not magic, nor was it a simple hunch. It was a science, a discipline built upon a foundation of immutable rules, rules that transformed him from a boy plunger into a Wall Street legend, and rules that, once understood, can serve as the ultimate shield against financial ruin. These principles were not born in a classroom or from abstract theory. They were forged in the crucible of devastating losses and spectacular victories. They are the architecture of a mindset that conquered the most formidable of all adversaries, the trader's own human nature. To understand Livermore's method of selling is to understand the very essence of market dynamics, for he did not merely react to the market, he anticipated its soul. He recognized that the art of speculation was not a game of hope, but a business of probabilities, governed by the unwavering law of supply and demand, and dictated by the single incorruptible voice of the ticker tape. What follows is not a collection of vague aphorisms, but a dissection of the 6 foundational pillars of Livermore's exit strategy. These are the mechanical, psychological, and strategic triggers that told him, with chilling accuracy, when the end of a move was not just near, but had arrived. Mastering them requires more than memory. It demands a radical shift in perspective, a commitment to a discipline so rigid it feels unnatural. Yet for those who embrace it, it offers the key to unlocking consistent profitability and, more importantly, to surviving the game. The principles are as relevant today as they were a century ago, for while the players and the stocks may change, the game itself, driven by greed and fear, remains eternal. For those who wish to delve deeper into the mind of this master speculator and understand the full context of his journey, a unique resource has been prepared. A link to Edwin Lefebvre's timeless classic, Reminiscences of a Stock Operator, is provided in the description below. This version is accompanied by a new, detailed chapter-by-chapter analysis from Max Davidson, an analysis specifically designed to translate Livermore's century-old wisdom for the modern reader, making his lessons more accessible and actionable than ever before. This guide is an invaluable companion for anyone serious about mastering the market. The first and most fundamental rule in Livermore's arsenal was deceptively simple. Yet it is the one most universally violated by traders, both novice and seasoned. He operated under the unshakable belief that the first loss is always the smallest and best loss. This wasn't just a clever saying, it was a non-negotiable law of financial survival. When he initiated a position, he did so with a clear thesis, an expectation of how the stock should behave. If the market failed to confirm his judgment almost immediately, he did not hesitate. He did not wait for hope to blossom, nor did he give the trade time to work itself out. He exited instantly and without emotion. He learned this brutal lesson during his transition from the bucket shops, where he could move with lightning speed, to the slower, more deliberate world of the New York Stock Exchange. In his early days, he would lose his entire stake because the game was different. The execution was slower, and a lagging tape could be fatal. This taught him that any position that did not show a profit right from the start was a position that was likely wrong. If you make a trade and the stock immediately goes against you, it is a clear signal that your timing is off, and to remain in the trade is to substitute blind hope for sound judgment. The average speculator, upon seeing his first trade show a loss, is tempted to do the single most ruinous thing possible: average down. He buys another 100 shares at a lower price, believing he is improving his average cost. Livermore saw this for what it was, a fool's errand, the act of throwing good money after bad. He was adamant on this point: never average losses. To do so is to compound an initial error, to double down on a mistaken premise, and to transform a small, manageable loss into a catastrophic one. It is an admission that hope has replaced analysis. The market itself provides the ultimate verdict on your decision. If a stock does not act as you anticipated, the time is not yet ripe for the move. To argue with the tape is a form of vanity that no speculator can afford. The market is never wrong. Opinions often are. When you enter a position, you are testing a hypothesis. If the market's reaction is contrary to your expectation, your hypothesis is, for the moment, incorrect. The intelligent course of action is not to argue, but to accept the market's judgment and exit. The opportunity will still be there a few days or weeks later if the premise was sound, but the timing was premature. This rule is fundamentally a psychological one. It is the conscious decision to value your capital over your ego. The pain of taking a small loss is insignificant compared to the soul-crushing damage of a major drawdown. Livermore's genius was in his ability to divorce his emotions from his operations. He understood the treacherous interplay of hope and fear, recognizing that they become confused and inverted in the mind of the typical trader. When a trade goes against you, you hope it will turn around. When it goes for you, you fear the profit will vanish. Livermore's first selling rule was the complete opposite. He acted on fear when he had a loss, and on hope when he had a profit. If a stock dropped after he bought it, he became fearful that the loss could grow exponentially, so he cut it immediately. Conversely, if it showed a quick profit, he became hopeful that this was the beginning of a major move and had the courage to stay with it. This simple inversion of natural human emotion is the cornerstone of all successful speculation. Profits, he famously stated, can take care of themselves, but losses never do. The second rule of selling is a masterclass in patience and observation, a direct refutation of the amateur's desire to capture every last point of a move. Livermore was emphatic that one should never try to sell at the absolute top. Such an ambition is not only foolish but financially ruinous. The last eighth of a move, he noted, has cost speculators enough millions to build a highway across the continent. Instead of trying to pinpoint the peak, the wise speculator waits for the market to signal that the move has concluded. This signal often comes after a period of what he termed a normal reaction. In a strong upward trend, a stock will advance for a period and then experience a natural pullback on lower volume. This is a healthy and expected part of any sustained move. It is a moment for the market to catch its breath before resuming its primary course. A speculator should never be afraid of this normal movement. In fact, he should welcome it as confirmation of the trend's strength. The danger signal, however, appears in what happens after this reaction has run its course. If, following a normal reaction, the stock fails to rally and push into new high territory, it is a flashing red light. This failure to resume the advance indicates that the buying power that drove the initial trend has exhausted itself. The force of the movement has dissipated. When this occurs, the line of least resistance is no longer upward. It may be sideways, or, more ominously, it may have shifted to downward. To remain long in such a stock is to ignore a clear warning that the bull phase for that security is over. This is the moment to sell. This rule demands a profound level of patience. Having ridden a stock for a significant profit, the temptation to snatch that profit at the first sign of a reversal is immense. Livermore, however, learned from old masters like Partridge, the man he nicknamed Turkey, that the big money was never in the individual fluctuations, but in the great sweeping movements of the market. To capture these big swings, one had to have the courage to sit tight through minor reactions, to maintain one's position. This meant giving the stock room to breathe and the trend time to mature. But patience should not be confused with blind stubbornness. The moment a stock's behavior deviates from the established pattern of a healthy trend, advance, normal reaction, new advance, the speculator must be alert. If the rally after the reaction is feeble, or if it fails to materialize at all, the reason for holding the stock has vanished. The game is no longer to buy and hold, the game is to sell and exit. This is not a matter of opinion or guesswork. It is a direct interpretation of the market's own language, a message written clearly on the tape for all who have the discipline to read it. The third pillar of Livermore's exit strategy was his revolutionary concept of pivotal points. This was a more technical, almost mathematical approach to identifying the precise moments when a trend was either beginning, continuing, or most critically for our purposes, ending. He discovered that in the business of speculation, nothing new ever occurs. Price movements are simply repetitions of the past. By meticulously keeping records, he began to see patterns form, and he merged this with the critical component of the time element. His records, he said, began to talk to him. A pivotal point in his system is a significant price level that, once crossed, is expected to lead to a swift and sustained continuation of the move. He first observed this phenomenon with stocks crossing landmark figures like $100, $200, or $300. He famously traded Anaconda on this principle, buying it the instant it crossed $100 and riding a massive advance. He repeated the play when it crossed $200. These points acted as psychological gateways. Breaking through them unleashed a new wave of buying power. The key, however, was in the follow-through. The sell signal came when a stock crossed a pivotal point but failed to perform as it should have. His final trade in Anaconda illustrates this perfectly. When it crossed $300, instead of launching into another powerful surge, it only managed to crawl to $302.75 before faltering. Instead of the stock being difficult to buy, the market was being supplied with large quantities of it. This abnormal action was a clear danger signal. The vitality was gone. The follow-through was absent. Livermore didn't argue or wait for confirmation. He immediately sold his entire line, narrowly escaping a catastrophic collapse that followed shortly after. He refined this concept into a precise rule for confirming the end of a trend. After an advance, a stock would have a natural reaction. The low point of this reaction and the high point of the preceding advance would establish two new pivotal points. The stock was then expected to trade between these points. For the upward trend to resume in earnest, the stock would not only have to rally but decisively pierce the upper pivotal point by a margin of at least 3 points, or 6 points for his composite key price of market leaders. Failure to do so was a sign of weakness. The ultimate sell signal, however, was a break of the lower pivotal point. If the stock, after failing to make a new high, reacted and sold 3 or more points below the low of its last natural reaction, it was a definitive indication that the upward trend was over. This was not a guess. It was a mechanically generated signal from his carefully maintained records. It told him that the path of least resistance had irrevocably shifted downwards. This rule removed all emotion and opinion from the decision. The numbers spoke, and he obeyed. It was this systematic approach that allowed him to act with certainty and precision at the most critical turning points in the market. It is at this point in the journey where the mechanical rules meet the harsh reality of market pressure that many traders falter. The discipline to act on these signals, to trust the system over the siren song of hope, is often the missing ingredient. We created this channel not just to share knowledge, but to build a community of traders who understand this struggle. If you find value in these principles, subscribe to the channel and hit the notification bell. Return to this video or explore our others, not just for new insights, but as a place to refocus your mindset, especially after a series of losing trades. It is in those moments of doubt that a reminder of these foundational rules is most powerful. The fourth rule is the very heart of Livermore's trading essence, the unwavering discipline of tape reading to determine the line of least resistance. He viewed speculation as nothing more than anticipating coming movements, and to do this correctly, one must have a definite basis for that anticipation. For him, that basis was never an opinion, a rumor, or a fundamental analysis alone. It was the clear, unambiguous message of the tape itself. The tape, he believed, was the speculator's telescope, allowing him to see the battle between buyers and sellers in real time. His final judgment rested on one simple question: which side is winning? He asserted that prices, like everything else, move along the line of least resistance. They will do whatever comes easiest. If there is less resistance to an advance than to a decline, prices will go up, and vice versa. The art of tape reading was the art of determining this line. A sell signal was generated the instant he perceived that it had become easier for a stock to go down than to go up. This perception was not a mystical feeling. It was a conclusion drawn from the character of the transactions printing on the tape. For example, after a long advance, if a stock meets with heavy selling every time it attempts to make a new high, and if the volume on the subsequent reactions increases while the volume on the rallies decreases, the message is clear. The upward momentum is exhausted. The buying power that once effortlessly absorbed all offerings is now gone. The sellers are gaining the upper hand. The line of least resistance is shifting. To see this and not act is to commit speculative suicide. One of his core tenets was that one must not be too anxious to get into a trade, but instead, wait and watch the action of the stock market-wise. This rule requires absolute subordination of one's ego to the market's reality. A speculator might have a perfectly logical, well-researched opinion that a stock should be worth more. But if the tape shows persistent selling and a clear downward pressure, the tape is right and the opinion is wrong. To get sore at the market doesn't get you anywhere, he would say. To argue with the tape is futile. It does not go into explanations. Its business is now, not tomorrow. The reason for a stock's behavior might not be known for days or weeks, but the trader must act instantly or be left behind. Livermore demonstrated this principle countless times. He would be bullish and long of a stock, but if he saw the character of the buying change, if he saw support vanish and sellers gain control, he would sell out his entire line in a flash and often go short immediately. This was not indecision. It was the highest form of discipline. It was the recognition that his job was not to be loyal to a position, but to be on the right side of the market at all times. The tape was his commander-in-chief, and its orders were to be obeyed without question. The fifth rule reveals the mindset of the true professional, a principle governing the distribution of a large line of stock that is completely alien to the average trader. The amateur dreams of selling at the highest possible price on the ticker. The professional, Livermore understood, must sell when he can. That is, when there is a market to absorb his holdings. This opportunity for liquidation, this window of liquidity, almost always appears near the end of a major move, during the final frantic burst of public buying. A large part of any major market move, he observed, occurs in the last 48 hours of the play. This is the stage when the public, which had been skeptical during the quiet accumulation and the steady early advance, finally succumbs to the mania. The news is universally bullish, the tips are flying, and stories of fortunes being made are on every lip. This mass excitement creates an enormous buying power, a market that can absorb tens of thousands of shares without caving in. This, for the large operator, is the signal not to buy more, but to begin selling. The goal is to convert a massive paper profit into real cash with the least possible slippage. You cannot expect the market to absorb 50,000 shares as easily as it does 100. Therefore, the manipulator or large speculator must patiently wait for the requisite buying power to materialize. He has to sell when he can, not when he wants to. This means selling into a strong, active, and rising market. It is the exact opposite of what the public is doing. The public is buying into the excitement. The professional is selling to them. This process is not a single dramatic act, but a campaign of distribution. As he explained in the context of manipulation, the principal marketing of a stock is often done on the way down from the top. After marking a stock up to its highest possible point, the selling begins. The public, conditioned by the long advance, eagerly buys on the first reactions, viewing them as bargain opportunities. This demand from bargain hunters and short covering from traders provides the liquidity needed for the professional to unload the bulk of his line. Livermore's own actions mirrored this logic. When he had a large profit in a major bull or bear move, he did not wait for the final tick. He began looking for the market that would allow him to turn around, a market with enough volume and excitement to absorb his holdings. He saw the final explosive phase of a move not as a reason for more greed, but as his heaven-sent opportunity to get out. This is the professional's mindset. His job is not just to be right, but to cash in on being right. The sixth and final rule is a simple mechanical system for protecting profits while pyramiding a position, a method so effective in its discipline that Livermore immortalized its practitioner, a trader named Pat Hearn. Hearn, a professional gambler, approached the market not with hopes of long shots, but with a system designed to secure sure money. He understood that the key to winning was not in the brilliance of his entries, but in the ruthless efficiency of his exits, particularly when managing a position built upon earlier profits. Hearn's strategy was methodical. He would begin by buying a small lot, say 100 shares. If and only if that first purchase showed him a profit, for instance by advancing 1%, would he buy another 100 shares? He would continue this process, adding to his line on a rising scale, never buying more unless the previous purchase was profitable. He was pyramiding his position, but only on the market's confirmation that he was correct. This ensured his big bets were only placed when he was winning. The true genius of the system, however, was in its stop-loss mechanism. For every new lot he purchased, he would immediately place a stop-loss order just 1 point below the price of that most recent purchase. As the stock continued to rise and he continued to add to his line, he would move his stop up accordingly, always keeping it 1 point below his last entry. This created a trailing stop that protected not just his initial capital, but the vast majority of his accumulated paper profits. This method accomplishes two critical things. First, it makes it impossible to suffer a large loss on the entire position. A 1% reaction would stop him out, but his loss would be minimal, confined to a small drop on his last purchase while preserving the gains from all the earlier ones. Second, it automates the decision-making process, removing the destructive emotions of hope and fear from the equation. There was no agonizing over whether a reaction was temporary or the start of a major reversal. The rule was mechanical and absolute. Lefebvre contrasts this with the story of a trader named Roberts, who, after successfully using Hearn's system to make a fortune, abandoned it out of overconfidence. When a reaction came, instead of cutting his loss as the system demanded, he held on, listening to hope's whispers. He was wiped out completely. This cautionary tale serves as a stark reminder. A system is only effective if it is followed without deviation. Pat Hearn's 1-point stop rule was the ultimate expression of trading discipline, a simple, logical method for letting profits run while ensuring they never ran away.